Well, it was an ugly day on Wall Street. We saw interest rates spiking for the second straight day. We saw volatility going way up. That led to a sell-off in some key areas of the market, including the NASDAQ, which was down 1.8% today. Prior to today, NASDAQ was holding up reasonably well, but after today, we have broken down below some key support areas. The Russell 2000, which had already been breaking down here for the last couple of weeks, continued its slide. We're now at 3-month lows with the Russell 2000. The larger cap universe with the S&P 500 and the Dow are holding up a little bit better, but they were both down a little bit here today as well. So a lot of different things for us to keep our eye on. We want to see if this is going to unfold into something deeper or not. Remember, it's been quite a while since last February since we've had a deep pullback. So we'll see if this leads to anything or not. In the meantime, I wanted to concentrate today's trade application example on an area outside of the stock market, which has been a little bit calmer here recently. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 4th, 2018. For those of you that are new, welcome aboard. Make sure you subscribe to our YouTube channel. Also go to our description area where you can subscribe to our daily email list, which will allow you to see which stocks in the S&P 500 are giving you overbought and oversold cluster signals. We're also heavy users of Twitter. My handle's @BrandonVanZee if you want to follow me. We'd also encourage you to click like and retweet with these Market Outlook related tweets if you get value out of these on a daily basis. We also have a presence on Facebook. Feel free to join our group at the web address embedded in the logo in front of you. All right, with that out of the way, let's go ahead and dive into the analysis of the markets here today. And as you can see, I've got chart 4B pulled up in front of us for those of you that are premium Market Scholar subscribers. Remember, I did send out an email to everyone on Monday morning with some chart updates since we did go through a pretty sizable change here last weekend with the switch to the communication sector from telecom. But anyway, 4B here will show us the four major charts in the United States equity markets. We have the S&P 500 in the upper left, Dow Jones in the upper right, NASDAQ in the lower left, and Russell 2000 in the lower right. Now notice all four of the charts had a red candle here today. S&P 500 was down 0.82%. Notice that we now have a pink background colored shading, which reminds us that we now have a bearish posture on the S&P 500 according to the intermediate term line using the market forecast indicator. That occurs because that green line fell out of the upper reversal zone. As you can see, that green line is now sitting basically at 75.57 and falling there. So we've kind of gone back and forth on the S&P 500 from a posture perspective, from bearish to bullish to bearish to bullish, and we're back to bearish again. Now, before we make too much of it, I will remind you that we do have what appears to be a hammer candle, or at least very, very close to a hammer candle, where we have a long lower shadow and we close near the midpoint of the session here. Well, that midpoint happens to reside right on that rising 30-day moving average. So at this point, we don't have a significant breakdown in the S&P 500, and that is generally viewed as the broadest measure of the market. So that is at least somewhat hopeful, but you know, that could be viewed as a stretch as well. There's enough significant deterioration in other charts where you might see some offset there. The one bright spot of the market, moving on now over towards the Dow Jones, is that we continue to have a bullish posture with the Dow Jones. That's your mega cap stocks out there. Now, granted, that's only 30 stocks, right? So we don't want to read too much into that, but it is true that some of those Goliath companies out there have been holding up a little bit better. Stocks like Boeing have had some nice runs here recently. So the Dow Jones was down 0.75% here today, but we retain that bullish posture and we continue to trade above a rising moving average. So we don't have as much concern with the Dow Jones. Now on to the bottom two charts where we do have concerns. Notice the NASDAQ, so this is what I was mentioning in the intro. It was down 1.81% today. Now, it's not just the size of that breakdown that's concerning, it's also where it places us from kind of a candlestick positioning as well. Notice that prior to today's really nasty candle to the downside, we were trading above a rising moving average. So as of yesterday, we were looking okay. Yes, we did have a bearish posture as of yesterday because that background color of the chart did turn to pink yesterday. But because we were still above that rising moving average, it wasn't as concerning of an issue. Today, it's more concerning. Notice that where we closed, first of all, notice that we closed in the lower half of the candle's range. So that kind of distinguishes it from what we saw with the S&P 500 and the Dow Jones. So right off the bat, we know that the bulls were not able to regain as much control in the NASDAQ as we saw in those other indices. But in addition to that, where we closed here was basically at the lowest level, going all the way back to probably these candles right back here in mid to late August. So we gave up the entire month of September basically with the move that we've seen here just in the last 48 hours or so. So that is a bit concerning. Notice again, we closed here, which is actually just a hair lower than where some of the low prices of these candles were over here. So, the concern is that this once uptrending chart could very well turn into a downtrending chart under the right circumstances. Now, keep in mind as well, we're in October. October is a scary month for the stock market because historians remember that many of the market crashes occurred in October. Doesn't guarantee anything about this year. Obviously, it didn't crash last year in October or the year before, but it's just a scarier feeling for a lot of market participants, which may lead to their skittishness in terms of holding stocks. And so that could kind of, domino upon itself there. So you just got to keep your eye on that. Right now, we do have a bearish posture on the NASDAQ, which had been kind of a leading force in the market over previous years. Over here on the Russell 2000, remember Russell 2000 is the smallest cap companies in the market. And again, we saw continued pressure in that specific segment. Now, this is nothing new or out of the ordinary, right? We've had a bearish posture on the Russell 2000 since going back to this candle right here on September 25th. But even prior to that, you'll notice that we had more of the background color be pink than green on the Russell 2000, basically starting with this candle back on September 10th. So we're basically a month into this move right now on the Russell 2000. So this is not a big surprise here to see the bearishness. We've already been seeing the bearishness in the Russell 2000. Now, the good news is this: we're getting close to what's known as a oversold cluster signal on the Russell 2000. We're not quite there. Remember, our charting package here will show you a little red dot, or actually a little green dot, when that occurs. And so we're not quite there, and the reason for that is notice the blue line closed at 22.63 here today. That needed to close below 20 in order for us to have a oversold cluster signal. But we're awfully close, and it could very well happen tomorrow. Now remember, if that occurs, the oversold cluster signals have a better hit rate than the overbought cluster signals. In other words, a reversion to the mean is more likely than not over the ensuing month after the signal is given when we have those oversold cluster signals. So perhaps we're getting close. Enough damage has been done in the small caps where maybe, just maybe, there's a reason to think that a turnaround could exist. Now, just because we get to oversold signals doesn't necessarily mean that this will turn the entire chart around and then, we're going to wake up 2 months from now and be in an uptrend. It just means that right now we've gone down too far too fast. And remember, this posture is strongly bearish right now. That's why we have that dark pink background color that's displayed right there as opposed to the light pink that we just saw here on the NASDAQ. So again, Russell 2000 is definitely the weak spot of this market. But perhaps we're getting to levels where maybe a rebound is in store. Do note what I mentioned in the intro, that we are now at 3-month lows on the Russell 2000. Notice where we were at today versus these candles over here in late July, where we bounced from those candles and started to move higher. We're now below that key support area there. So that is definitely concerning, right? It's changing the shape of the various charts out there. Notice that the moving average on the Russell 2000 is now red. It has been here for about the last week or so, so this isn't anything new either. But it's just a reminder that, hey, when we have enough selling pressure on some of these charts, it will start changing the shape of the moving average, which will then start changing your expectations for future price action as well. right now, the path of least resistance for the Russell 2000 is to the downside, whereas we still can hold out some hope that the mega caps continue to lead this market higher. So we'll keep our eye on this story, but it is definitely more concerning today than we have seen more recently. So we don't want to just outright dismiss this selling action either. Let's go ahead and take a look at some other charts here. Since it is Thursday, let's take a peek here at our longer term chart, our 1040 crossover method chart. This is 4D for those of you that are following along at home. Now remember, this chart is going to look back longer period of time. These charts are 3 years in length as opposed to 3 months in length. And so when we look at this, what we're looking for are crossovers of the moving averages themselves. Now there's 2 different moving averages on each of these charts. The orange line represents the 10-week moving average. The blue line represents the 40-week moving average. What we're looking for are the crossovers of the moving averages themselves. And the last time we had any crossovers of the moving averages occurred more than 2 years ago, as all 4 of these charts went bullish. So just keep in mind context as well. I know it doesn't feel good if you're somebody who just started investing in the stock market in the last month, but you'll have to recall that most folks have been investing for longer than a month. And so despite the fact that this has been a rough go of things here in the last couple of weeks, we still have a very strong move from where we had the crossover that occurred 2 years ago. So had you been kind of on the right side of the market, in other words, the bull side of the market over the last 2 years, you should have done better than had you been constantly fighting against the market. Now, having said that, again, we have deterioration in the charts, and so we want to recognize that, and we want to keep our eye on it. Notice that a couple of weeks ago, we got this red arrow. It might have actually just been last week. We got this red arrow on the Russell 2000. Now that red arrow occurred when price fell below the 10-week moving average. So notice that the crossover of the moving average has not occurred yet because the orange line is still above the blue line. But the price of the Russell 2000 closed below the 10-period moving average, and that can sometimes be an early indicator that there's going to be more stress on the system. Now, I will also remind you that there's been plenty of time. Notice all of these red arrows that occurred in the last 2 years on the Russell 2000 chart. None of them led to an actual crossover of the moving averages themselves. But eventually, when that does occur, it will start with a red arrow up there at the top. And you'll notice that not only did the Russell 2000 give us that red arrow last week, but as of this moment in time, we now have one on the NASDAQ as well, right? And again, these are weekly candles, so if we get a bounce back tomorrow on Friday, that could disappear. But as of right now, again, that's telling us that the NASDAQ is starting to show a little bit more wear and tear as well. The last time we had a red arrow on the NASDAQ would have been way back here in April when we had price below the 10-week moving average. So, you know, we're starting to see those signs creeping up, that we do have, you know, some things to be a little bit more concerned about right now. And it's not, you know, a panic head for the hills type of a moment. We don't have massive breakdowns across the board, but we have enough kind of instances to make us sit up and pay attention a little bit more. Let's take a look at a few other charts while we're at it. Let's take a look here in this case. I'm going to go over to a different chart that we don't often look at, but I'm going to look at chart 4R in this particular case. And the reason I wanted to is because what I mentioned in the intro, where we did have a spike in yields again today. And that has had a little bit of you know, negative effect on the psychology of traders out there. Now remember, when interest rates rise, it generally is a way for the economy to have an excuse to slow down. Sometimes it's psychological, sometimes it's real. Remember, when interest rates rise, the cost of borrowing money goes up, and therefore you can't expand if you're a business as rapidly if your profit margins are being chewed up by higher interest rate charges as well. But right now we haven't seen that significant of a move. It's just at the top of investors' minds. Well, as you look at this 12 grid here, this is chart 4R for those of you that are following along at home. We have a clean sweep of pink charts. Remember, we don't see that all that often. But in this case, these are all different fixed income instruments. So you have US bonds up here, you have foreign bonds up here, you have high yield bonds, you have corporate bonds, short-term treasuries, medium-term treasuries, long-term treasuries, inflation-protected treasuries, muni bonds, convertible bonds, floating rate bonds, and mortgage-backed securities, and you can't find a bullish chart in any of them, right? You went 0 for 12 here. That's what happens when interest rates rise. Bond security prices go down, and that's where we're at right now. Not only bonds go down in price, but we also typically find that real estate investment trusts, oftentimes master limited partnerships, and other high-yielding asset classes struggle, preferred stocks, et cetera, et cetera. So right now it's been ugly out there if you're stuck in fixed income instruments, but we are starting to see some signs of maybe oversold conditions. Notice that we had a oversold cluster that showed up on BND. That's a very popular bond ETF. Now that's an aggregate bond ETF, so that can be used as a proxy for all the various US bonds out there. But that just goes to show you how extreme the selling has been. We've got a oversold cluster signal there as of today. We also, if that wasn't enough in the United States, we got an oversold cluster signal here on foreign bonds, which is just BNDX at the end. And that will cover the foreign bond market. So bonds in the United States and across the globe selling off significantly to the point where we're getting some oversold signals at this point. We also found oversold signals here with corporate bonds today. We saw an oversold signal on short-term treasuries yesterday. We saw an oversold cluster here on the medium-term treasuries today. We saw a cluster signal on long-term treasuries today. We saw an oversold signal on inflation-protected treasuries today, the TIPS. We saw an oversold signal on muni bonds. And then last but not least, also on mortgage-backed securities. So, you know, it's ugly out there if you're investing in bonds as well as stocks. I know many of you probably just are individual investors in your stock portfolio, but if you do have bond exposure, let's say in your 401ks or what have you, that area of the market is struggling pretty ugly as well. And the reason is back to what I mentioned before, which is rising interest rate environment is really forcing bond prices lower and lower and lower. So it's ugly out there. Let's take a look at a few other charts here while we're at it. Wanted to spend just a quick moment here on chart 4I with the ratio charts. In particular, I want to just point out this chart down below here, RSP, SPY. So when you see this orange chart start in the upper left and go down to the lower right, that is a bad sign. That's basically a way to kind of get a sense of whether we have strong breadth in the marketplace or not. With the idea being that you need lots of generals and soldiers to win the war. And sometimes when you're only looking at the S&P 500 or only looking at the Dow Jones, you're just kind of looking at the generals. You're not looking at the soldiers. When you're looking at RSP, that's an equal weighted version of the S&P 500. So every one of the 500 components has an equal weight compared to the other 499 that are in the index. It's not market cap weighted the way that SPY would be. So when you see underperformance here or a downtrend like we see, it's telling us that the average stock in the S&P 500 is not pulling its weight, and that if there is any semblance of strength in the market, it could be kind of housed within some of the larger components out there like your Boeings or your Caterpillars or what have you. Now, this is not a surprise over here. IWMDIA, we've known that for quite some time. Small caps have been struggling as well. So that kind of, takes you to that same narrative of the market where you want to see broader strength, broader exposure out there. So those would both be viewed as kind of bearish elements of this market. You'll also notice over here, kind of lower left in that green chart there, that's the growth stocks by value stocks ratio chart. And growth stocks had been leading this market up, but notice how ugly that candle was today to the downside right there. And what that's telling us is that value stocks vastly outperform growth stocks as of today alone. And remember, that's not necessarily the best thing. If you want a stock market that's firing on all cylinders, you want a risk-on environment where growth stocks are outperforming value stocks. You want a risk-on environment where small cap stocks are outperforming mega cap stocks. But that's not the environment that we're in right now. But again, back to my point that I was making a moment ago, it's not like you can just transition out of the stock market into the bond market, because the bond market's getting hammered right now as well. Notice that this chart here in the green in the middle is showing us stocks to bonds, and that continues to look like it's an uptrend. And part of the reason for that is because bonds are going down equally as fast as stocks. And so a lot of times you don't see that. You see money kind of drifting over towards bonds, but that's not what we're seeing right now. What we are seeing is something that I mentioned in the Tuesday video, which is commodities are starting to perk up a little bit on a relative basis. Check out this kind of turquoise chart off on the left-hand side here. For much of the 3-month period that this chart covers, the stock market was the place to be. It was outperforming commodities. But notice the reversal that we've had here in just the last month or so. When you see this chart going down like we have in the last month, that's telling us that commodities are now outperforming stocks. So keep your eye on that as well. And then also I notice up here, emerging markets continuing to struggle. Notice emerging markets going down, 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 down versus the developed markets. That's another bad sign. Typically, you want a risk-on environment where emerging markets are outperforming the developed foreign markets out there. So more signs right now are leading to wear and tear, if not outright bearishness in some of the cases. So just keep your eye on that story. I do want to show you another chart here briefly. Let's go to chart 4K. And this will be our volatility chart for those of you that are following along at home. And I want to pop in there QQQ, which covers the NASDAQ 100, since the NASDAQ was really the area of the market that was taking it across the chin the worst here today. I like looking at this particular chart on the very wide or big range days. And the reason for that is this area kind of in the middle here that I'm pointing at or circling with my mouse. It gives us a nice visual representation of how big a pullback was in comparison to other days for that exact security over the preceding 6 months in this chart's case. So notice the NASDAQ was down almost 2% today. The QQQ was down nearly 2%. So that's why you see this red bar right here go all the way down, almost touching that orange line down there. That orange horizontal line would be if the NASDAQ was down 2% today. So it was just shy of hitting that. So I wanted to point out how rare it is for us to see a nearly 2% pullback type of a day. We would have to go all the way back to this day right here. Looks like it would have been June 25th, since the last time we had a 2% pullback in the stock market. So, you know, it's been a number of months, you know, probably 3-4 months since we've had a day as ugly as we saw today for the tech stocks. Prior to that, we had a candle over here back in April where we were down 2%, and then one more where we were down 2% back here in early April. Now, you will notice that when we got those big 2% days, like this would have been the candle that was associated with it, the end was near. We eventually got a pullback higher onto new all-time highs after that. Same thing can be said over here. By the time you got this 2% pullback, that was at the down draft of that move, and we were about ready to move a bit higher. And even the same thing could be said right here. This was the end of that move, and we went higher. So is it possible that we're getting close to an end of the move? Maybe. But what I would say that's different about this time is, you know, unfortunately, this is really the first move here in the most recent time period that it's been down. Notice like over here, we had several days in a row of price pressure. So that leads you to believe that perhaps we've got another couple of days of selling pressure in front of us, despite how ugly today's movement was. Let's take a quick peek here at the intermarket analysis 12 grid for E, because I just wanted to briefly show you the VIX. The VIX was up and spiking pretty nicely today, 22% the VIX. Now, keep in mind context here. That is a big move. There's no denying that. But it's still at a historically low level, right? 14 is not high on the VIX. It used to be that we used to think that 20 was considered very low on the VIX. So that just, you know, kind of puts that into perspective there for you. And even at the height of today's spike on volatility, we still weren't at the height of the volatility that we saw just in August on the VIX. So this was not a, capitulation, flush the toilet type of a day for the stock market. It could have been a lot worse, and that's almost the concerning part, right? Sometimes you just want to rip the Band-Aid off and get it over with. Well, right now there's still some evidence to suggest that there may be a little bit more pain in front of us. We'll have to keep our eye on the story. But I do want to kind of point out the gold chart down below here. Notice that gold has been steady to the sideways side here recently as well. We saw ag commodities pop earlier this week. We did pull back a little bit the last couple of days, but we remain above a moving average right there on that one, and we do continue to have that bullish posture on ag commodities. And then crude oil, we had a pullback day on crude oil, down 2.3% here today. But again, that's been in a nice upward ascent here. So, that could very well lead to buying opportunities in crude oil if it pulls back any more. I did want to briefly kind of move on over here to the internet and just remind folks that Thursdays are the days that I teach my question and answer session here at Market Scholars. So if you are a premium Market Scholar, you're welcome to go back and watch the recording that's now available on it. The questions that we covered today had to deal with locating some tutorials, also talking about what are some of the different things that make interest rates go up and how does that affect TLT and what other factors are important to it. We also talked about the idea of emotional trading based off of, some of the rising bond yields out there. We also talked about a Spotify bearish trade that we talked about in my my strategy lab class the prior night. We also talked about Wells Fargo, which I noticed was actually up today. So remember, not all stocks were down today. Some of the financials were actually up. We also talked about some mutual funds. We talked about position sizing. We talked about some of the financially or actually interest rate sensitive areas of the market like real estate and utilities. We talked about sectors from a small cap perspective. And then we talked about a speculative trade here in Amarin, which has been a stock that's basically gone from $3 to $20 here recently. So anyway, a lot of different things there to sink your teeth into. If you are a premium member, feel free to check out that recording. And remember, David will be doing his question and answer session this coming Saturday morning. And then lastly, if you're watching these videos for the Market Outlook on our website, on our blog, remember we've made it nice and easy for you to let us know that you appreciate the time that goes into creating the videos on a daily basis. All you have to do is give us 3 different clicks. One click here on Twitter will let us know that you like the presentation. Thank you to the 107 of you that did that for me on Tuesday. You can also like us here on Facebook, and then we also have a like right here on our website as well. So thank you to all of you that do that on a consistent basis. We do really appreciate that. Let's now talk about our trade application example for the day. So I want to come back on over here now to chart 4A, which is just a 1 grid for the market forecast view. And so for this, I'm going to type in ticker symbol GLD. Now, as I mentioned just a moment ago, gold has been stabilizing. It's actually been holding up. And remember, sometimes when money starts flowing out of things like stocks and bonds, sometimes it finds a home in commodities. Not always, but sometimes it does. And right now, we actually saw gold was up today, but not extremely high, right? It was only up 0.05%. So it was kind of flat, but in comparison to the 1% plus move that we saw down on the NASDAQ, I suppose on a relative basis, it was an outperformer here today. But what I'm looking at with gold is the fact that it's just really been holding the line. And it's been doing a really good job of that for at least a month at this point. Really, gold started bottoming with some of these oversold cluster signals right over here in the middle of August, had a nice little pop higher to that moving average, and has basically been riding this moving average ever since then. So over a month, it's just been riding that moving average. Now, when you have a chart that looks like this, that is quite neutral or directionless, one of the ways that you can try to take advantage of that is by looking at what's known as an iron condor. And remember, when volatility spikes like it did today, it makes prices of options a little bit more inflated than they would be otherwise. And so after a big volatility spike day like today, sometimes you want to be the seller of premium. And that's effectively what you'd be doing if you look at an iron condor. So I thought that's what we would concentrate on here today on GLD. So for that, I'm going to come on over here to the trade tab. And then we're going to pull up our trade. So what I typically do is I look for 20 to 50 days of expiration. So right now I'm looking at the November monthly contracts with 43 days of expiration. And then I'm going to look for a delta of 20 to sell. And so in the case of the puts, I'm looking at this delta column over here, and I see that there's a delta of 18 here that'll do just fine. And that would be selling the 110 put and then buying the 109 put. On the call side of the equation, if we start looking at deltas over here, that would lead us to, let's do the 23 delta right here. That would be the 117 that we would be selling, the 117 call, and the 118 call would be the one that we're buying. So let's load that up and see what that can generate in terms of a credit for us. So I'm just going to come over here to the 110 put, right click on it. I'm going to go to sell. I'm going to go to Iron Condor. That loads up kind of the generic view of that down below in the trade area of paper money. So I don't need to adjust the put side because I'm going to leave it with the 110 put that I'm selling and the 109 put that I'm buying, but I do need to manually change the call side. So the sold call side that we were looking at there a moment ago was the 117. So let me pull that one in. And then the bought side for the call side was going to be the 118. And you'll notice that if we load this up, it does give us a credit of 28 cents, which should lead us to more than a 30% return on risk. In fact, it's enough over that because usually if you're doing $1 wides, anything over 24 cents will get you done. So this is enough where it makes me wonder if I'll be able to switch that on the call side from 117, where we saw the 23 delta. Maybe I'll be able to sell the 118 and buy the 119 instead. Let me just check that real quick. I don't know if this will work, but it's at least worth a shot. So let me change this to the 118, and let's change this to the 119. We're almost there. We're almost there. So I might actually just leave it in like this, and what I'll do is I will bump this credit up to 24 cents. It's at 23 cents right now, so we're basically borderline on whether we would be able to get done at a 30% return on risk or not, and it really depends on whether you want to round up or not, because if you do a 23-cent credit on a $1 wide, if you round up, you technically have a 30% return on risk. If you don't like rounding up and you want it to officially be over a 30% without rounding, then just bump that up to a 24-cent credit. If I click on confirm and send here, I can get my calculator out and just kind of show you that if you take the $24 of max profit, divide by the $76, oops, hang on, 24 divided by 76, that gives us a 31.5% return on risk. Now, obviously, you're going to adjust your position size as necessary. I'm just doing one for educational aspect here, but obviously, you're probably going to do more than one contract. But the math will hold no matter how many contracts you're doing from a percentage basis there. So a 31.5% return on risk there. And what you're hoping to accomplish with an Iron Condor is continued neutrality in the product that you're looking at. So in other words, notice that the Iron Condor here has two break-even prices. One of those break-even prices is 109.76. One of those break-even prices is 118.24. So in other words, we have a stock, or in this case an ETF that tracks the price of gold, that is trading for $113.48. And what we want is for that to stay sideways for the most part in the next 40 plus days. And so if we went back on over here to the chart just to kind of gauge where those break-evens will put us, hang on just a second. There we go. Let's actually draw them on the chart here. So I'm going to go to my drawing tools, use a price level here, and I'm just going to draw one line at the top and draw another line down here at the bottom, and then I'll adjust these accordingly. So on the top one, I'm going to right-click. I'm going to edit the properties, and I'm going to go to the value of 118.24, which was our upside break even. And on the downside, I'm going to right click on that dotted line, go to edit properties, and I'm going to go to 109.76, and that's where our break even is on the downside. So in other words, you have to ask yourself the question, do you believe that gold will continue to trade within this sideways channel for the next 40 days or so? If you believe that it's not going to break out to the upside huge or break to the downside huge, then perhaps it's a good enough trade for you to consider. Notice that if it were to come and threaten the downside break even, it would have to go through those prior support candles that we saw back here in August where we were getting those oversold signals. If it were to break through our upside break even, we would have to go and retrace price action going all the way back to probably this candle back here on July 10th. So if you think that all the chaos in the stock and bond market around you will lead to a relative calm in the gold market, then taking this iron condor trade could be an interesting idea. So I'll go ahead and put that one in, and we'll see how we do here tomorrow. All right, well, I want to thank you for joining me here tonight. It was a chaotic day on Wall Street, but remember, brace yourself. There's certainly opportunity for further pullback in price, which can lead to opportunities as well for those of you that are longer-term investors looking to put money to work. So remember, with every major extreme movement in the market, there are opportunities that exist out there. Tonight, we concentrated on gold as kind of a relative safe haven out of the chaos of the stock and bond markets with our trade application example. So David will be back with you tomorrow. Enjoy that presentation. I'll see you all next week. Have a great weekend, everybody. Take care. Bye-bye.